What's an iron condor? An iron condor is an option selling strategy. It consists of two credit spreads, a bull put spread, and a bear call spread. Iron condor is a delta neutral strategy employed in neutral markets, and it's a high probability trade. It's an income strategy employed by traders to generate income on a monthly basis. Let's take a look, and if we create a one put spread, let's say it's October and NDX is trading at 1685 levels, and if we sell a put spread here, which is a vertical, selling a 1475 put and buying a 1450 put, we get a credit of $1.15. So that is so far so good. It's a put spread, it will expire. But what if your outlook on NDX is a neutral outlook, meaning that you think that NDX is not going to go up or down, but will stay within a certain range? So what kind of a strategy would you employ? An iron condor is essentially a neutral strategy, and that would be an ideal situation to employ this strategy in trading NDX. So here's what iron condor would be consisting of. First, it will have a bull put spread, which we already did here, and we got a credit of $1.15. Let's go ahead and get another bear call spreads much above the price, and let's see what happens. We would go ahead and sell 1875 calls and buy our protection, which is 1900. So this is what essentially the trade will look like. It will have four legs, one on the top and one on the bottom, and here's your price. The break-even points as shown on this dotted line are 1476, and here they are about 1877. So as long as NDX stays here till the October expiration, which is almost 45 days from today, and if our price stays between these two legs, then we should be making a profit of $1,950 in between these two lines. And that's what basically the concept is of taking in time premium, time decay, or theta, and capitalizing on it and making an income. Basically, it's an income generation strategy actually, and is taught by many people in the seminars and so on and so forth. Let's go ahead and take a look at some of the technical analysis that goes into placing an iron condor. Iron condor is not placed in a vacuum, but usually professional traders and people who trade them successfully usually take a look at the first thing they do is that they take a look at some of the technical analysis. Here's a chart of NDX. It's a yearly chart, as I've drawn a trend line here. This is a long-term trend line, and this is where it is consolidating here, and it broke out from here. Right now it's trading at 1685. So as per our break-even points, the 1476 and 1875, this is the rectangle or the area of profitability where the iron condor would be successful. So if you have a technical opinion on it or knowledge about it, or your thinking is that at least NDX trading at 1685 would stay between these 2 points, then your iron condor would be very successful, and you should be able to make out the maximum amount of money. So the trade has to expire between these two areas, or the area of the white rectangle, in order to make money. Let's go back here quickly and go back to the chart graph of iron condor. Let's take a quick look at the Greeks on iron condor and what do they mean. It's actually a neutral strategy, so the delta when you're placing this trade is almost minus 2.0, a neutral delta neutral position. That means it does not have any movement on this side or that side, and you're assuming that this price is going to move. Not going to move, but that is actually not the case. The price does move, and this delta always changes, and that is where the problems start. The gamma in it also is pretty neutral, is minus 0.50, and the theta, which is the most important aspect a trader is looking, is $96.38 per day. That is what you're making here on this trade, should the trade just stay here and deteriorate. And that's what the trader is hoping to make. And this delta theta starts increasing as the times goes by, as it goes higher and higher. Let's take another very important Greek, and it's called Vega, which is at minus 278.33. What does that mean? It means if the volatility drops by 1%, you will gain $278. So iron condor is basically a volatility sensitive trade, and a trader has to pay quite a bit of attention in knowing what the levels of volatility would be in order to succeed in it. Should the volatility go up, you're going to lose about $278.33, and that is no fun. So basically, that is what in a small video this we can clamp this thing in together is an iron condor. And if you know these ranges and your opinion is of the stock or an index in a neutral position, then iron condor is the vehicle trade, and you can benefit that and make a lot of money in terms of an income. And this is a purely an income generation strategy that we employ all the time in our service here, and we use these types of strategies very successfully.